So that's another example of a volume imbalance. There was one on GBP USD too. Let's go and look at it. Good. This is GBP USD. 4-hour time frame. Look, you see volume imbalance. So let's write our notations. Volume imbalance on the 4-hour time frame. What did they do afterwards? Traded right into this bullish order block. So that's a bullish order block on the 4-hour time frame. So you see, then they went up. How many pips? Assuming you bought on the bullish order block, 36 pip drawdown, over 260 pips. I didn't see this thing. I would have traded it. Another volume imbalance. They have filled it. And this is a bearish order block resting right above it. Have they traded into it? They look like they have. Because this is a draw on liquidity. This long wick. That's a liquidity pool. So you can see the market trade back to clear it, then trade into this bullish order block, and then it continues going up. So you can be monitoring it throughout the week to see what will happen. See, went up. There's another one here. They are finished filling it. There's a bearish order block here. So this is all liquidity. This is liquidity. Liquidity, liquidity, liquidity. So that was it. After filling it, they went up. Now they have filled this one. They are likely to come back down. Good. So you guys said you understand. So let's look at the next thing. Liquidity void. Now, how does a liquidity void look like? Hey, this thing was shy of my buy zone by how many pips? I've been monitoring this pair to buy on this order block. Oh, no, okay. I was actually waiting for them to clear the sell side liquidity, but they haven't. Okay. Then they should go up and clear the buy side liquidity so we can sell it. So, what does a liquidity void look like? Now, if you attended my lesson on price action or market structure, or if you didn't attend but you happen to watch the video, I said in a bearish market, this is how the market is supposed to move. Like this, like this, like this. This is normal price action. This is abnormal price action. And in a bullish market, it's supposed to move like this. The pullbacks or retracements are corrections. We refer to them as corrections. They are necessary because they form balance in the market. If there were no retracements, there will be absolutely no balance in the market. And that would be bad. That would be terrible for the market. So pullbacks are necessary because they are corrections and they result in balance in the market. So when you have something like this, this is nonsense. This doesn't make any sense. This type of drop. Now, when you have candlesticks of the same color or nature following each other, a lot of them, 3 and above, that's abnormality. Like here, from here down to here. This is nonsense. This does not make any sense. This is very unhealthy price action. And so there's a void that is created by this imbalance. Because remember what I just explained with regards to bearish markets. It's supposed to move like this. But look at this example. It just moved like this. Boom. So this is nonsense. This is not supposed to happen in the market. Now, this type of moves are caused by involvement. Is that the right word? Yes, the involvement of the big guys in the market, the institutions. These guys, I've always been telling you, have big volumes because they trade with big volumes because they have a lot of money, hundreds of billions of dollars. So when they enter a trade, it carries a lot of weight. So because of their big volumes, they are able to cause the market to move aggressively. Okay, and with regards to which direction it moves depends on what they are doing. If they are buying, you see move aggressively in the upward direction. And if they are selling, you see it move aggressively in the downward direction. Now, retail traders can never cause this type of movement. Retail traders can never cause this type of movement. Why? Because retail traders combined don't have the type of money that these market makers or market movers do have. Okay, there's quite a number of retail traders that have millions and are quite rich, but then retail traders combined don't have the might to cause this type of movement. This type of movement is caused by the sharks, the big sharks in the business, the elephants in the business. Okay. So when you see this, let's extend it to the right. Anytime you see something like this, and then later you see it came down this way, this was a downward motion. Then later the market moves up in the opposite direction to fill that gap or that void. Once that void is filled, you have to start anticipating sell opportunities. Now, it is not a very good idea to just sell because a void has been filled. You have to identify premium arrays. And you know what premium arrays are? I'm talking of bearish order blocks and break in market structure. Bearish order blocks and break in market structure. Okay. Now, if you look at this properly, we have a bearish order block here. Yes, so they traded into the bearish order block. Ideally, I would have added this wick, but it's too long, so I'll leave it out. The upper wick is too long for my liking, so I'll use just the close of that bullish candle. So they filled the gap by trading upwards in the opposite direction of which this gap was formed. Now, after filling the gap, they traded right into that bearish order block. Then they sold from there, and you can see it. It's very obvious on the chart right now. This is exactly what I'm talking about. So when there's a void, we must wait for them to fill the void. We must not buy from here because we think there's a void, so they are going to go up to fill it. I ever tried it. The very first time I was introduced to this concept of liquidity, I saw a gap. Then I said, oh, if there's a gap, it was on CAT JPY. Oh, no, it wasn't. It was one of the volatile pairs. So I said, oh, if there's this gap, it means they're going up to fill the gap. So I just bought from there. And the thing dropped for over 600 pips. Yes, it blew my account. Very simple. That was the first time I was introduced to this concept. So what I always advise is that wait for the gap to be filled before you take action. Don't say there's a gap, so I'm going to buy for the market to go and fill that gap. Yes, there's a gap, but we don't know when it's getting filled. But we do know that once the gap is filled, there's a strong tendency that the market will move in the opposite direction now. So it's always advisable to wait for the gap to get filled first. Now, there is not only one pair on the market. So if you've identified a gap and you think that it's going to take a long time for the gap to get filled, monitor it, don't trade it, but look at other pairs for opportunities. Do you get me? So don't participate in a trade because you've seen a gap and then you feel that if you buy, the market will go up to fill that gap, or if you sell, the market will come down to fill that gap. Yes, there's a gap. When will the gap get filled? We don't know. But when the gap gets filled, is there a high tendency that the market will move in the opposite direction? Yes, there is. So to be safe, why don't you wait for them to first fill the gap before you now make a decision? We have to be smart. I think it's smart to wait for the gap to be filled before we make our trading decision. Instead of saying we are going to fill the gap. You can't fill in a gap. The market, wait for the market to do what it likes. Then you also participate. Or in the process of filling the gap, if the market gives you a nice setup, like here, if the market gives you a nice setup, like this buy from here all the way to here, the market gives us a nice setup. How? Look at it. It gives us a nice turtle soup buy model. Look at these equal lows, those wicks. The market came down to fill them nicely or to clear them nicely. After clearing those equal lows, what did it do? Traded right into this bullish order block. Typical example of a turtle soup buy model. So you could have participated in this trade. Yes, if you had bought from here, the market would have gone up. Look, sell side liquidity right here. Now the market has come back. It has cleared this equal lows down here, traded into this bullish order block. Then we had a what? A spring or a spike. Do you get me? Now, when that spike happened, you have to take all these things into consideration. After that spike happened, a fair value gap was formed. Look, so there was inefficiency. So the market has to come down to correct that imbalance. So they came back to fill that fair value gap and then found support again on this bullish order block right here. Then consolidated for a little. Boom. So look, this consolidation was the first phase of this movement. The market has got three phases. We have consolidation, we have manipulation, then we have what? Accumulation. So consolidation, manipulation. What were they going out to manipulate? These stop losses. They went out to clear these equal highs or these liquidity pools. That was the manipulation. So after the manipulation, what's the next phase of the market? distribution. So this is now the real intention of the market. See how many pips did it drop for from that sell? Dropped for 509 pips. This is how you analyze the market. So when you are doing your analysis, you must take your time to observe all these things. When you observe them and you plot and you make your annotations, it makes trading very, very simple for you, very easy for you. So all you do is you do the analysis, you write the annotations and all of those things. And now you fold your arms or you cross your arms and wait for the market to get to those zones. Then you pull your trigger. So you are acting like a sniper. You have set your gun, whether it's a rifle or whatever type of gun you are using. You have set everything. You are lying on top of that skyscraper or that cliff. Now you are just waiting for your target to approach. So when the target approaches, you don't waste any time. You have to isolate the target so you don't hit other people. So when the target comes and is isolated, you pull the trigger, poof, target is down. You are a sniper. You have achieved your goal. Then you are going to wherever you want to go to. That is why I like this guy, Matt Damon, who acted the Born Identity and Born Legacy and that series. You see, in trading, let's try to be like Matt Damon. Let's not be Arnold Schwarzenegger, who comes out with his big machine gun that has a coil around it, and he has just one or two targets. He's shooting everywhere. Yes, eventually he hits his target, but in the process of doing that, he destroys a lot of property. That is not smart. Let's be like Matt Damon in the movie. What was his name? Jason Bourne, who waits for his target to appear, then he pulls the trigger. He doesn't destroy any property. He hits just his target and he's done. Clean job. That's how we should be trading. So you do your analysis, do your annotations, fold your arms and wait for the market to get to those levels. Then you pull the trigger. So you see, that's exactly what I'm saying over here. So let me explain this movement you are seeing once again. I was saying that when the gap is formed, do not be in a hurry to participate in a trade that you think is going to fill the gap. But in the process of filling the gap, if the market presents you with a very nice setup, this is one of my favorite setups, a turtle soup buy model, where they clear previous lows and then trade into a bullish order block, then they move up. So in the process of going up to fill that gap, what did the market do? It formed equal lows over here. They traded down to clear those equal lows. After clearing the equal lows, they traded right into this bullish order block. Then we saw a very serious rally on the 21st of October. Serious rally. And that rally also caused an inefficiency in the form of a fair value gap. They came back to fill that gap. Then the market consolidated a little, then pushed up. So you could have been part of the manipulation phase of the market. Then you get out and now enter for the distribution. So accumulation, manipulation, distribution. This is what is referred to as the power of three. Next year, I'll be teaching it into detail. The power of three, the phases of the market. Do you get me? Good. So you see, after filling the gap, they traded into that bullish order block. There was some form of consolidation. This is not really consolidation. We had some form of delay. Let's put it that way. It didn't move swiftly. There was some form of delay, and then the market dropped nicely for about 509 pips. Traded back into that bullish order block. The market has memory, remember? And in the process of trading back into that bullish order block, once again, they cleared equal lows and formed yet another turtle soup buy model, cleared the equal lows, traded into that bullish order block, got rejected, then traded back up. Okay? On their way up, what did they do? This is a drawn liquidity. That's old high. They cleared it, then traded into the breaker. See, it got rejected at the breaker, and now it came down.